Since the last recession, we've seen the extraordinary phenomena of negative headline interest rates. That is, interest rates that pay back less than the borrower lent, and therefore have negative yields. Essentially what this means is that people are paying to lend governments, mainly, money. This is completely extraordinary because it doesn't make logical sense. Why would you lend someone money if you're going to lose money on the proposition? You'd be better off just holding the cash and putting it under your mattress. Yet the phenomena of negative nominal interest rates is occurring and exist. Interest rates became negative after the recession, then they became positive-ish again recently, or at least they broke even in Europe and for short-term rates in the United States. But now in Europe they're going outright negative again. While negative real interest rates were the headline interest rates lower than the inflation rate, so you're losing money in real terms, is a bit more plausible, because if you were just holding on to the money in cash, you'd still be losing the same amount of money anyway. The phenomena of negative nominal or headline interest rates is fascinating because it goes against common sense, because in that case you could just hold on to the money and not lose the value of it. So anyway, the last article I read brought up and mentioned this when talking about economic conditions in Germany. So I thought I'd continue to look it over. So I'm bringing up this article from the Financial Times, and I'm going to be reading it. No one wins in the rabbit hole world of negative interest rates. Hiding money in vaults might not be the ultimate intention, but it's a cheaper option. Exactly what I was saying. It emerged last week that UBS is planning to charge its wealth clients, those with more than 2 million of deposits with the Swiss bank, that's probably Swiss francs, a negative interest rate. Credit Suisse is thinking of doing the same. Other private banks already do this. With the ECB expected to move its rates further into negative territory in the coming weeks. Yeah, because this is also very important, because while some central banks have experimented with negative rates in the past, and bond yields have gone into headline or nominal negative territory recently in the past, the ECB right now is going to explicitly be doing negative interest rates for the first time ever. So that's an unprecedented move that's absolutely fascinating. And obviously this is a big deal that's worthy of attention. That's completely unprecedented. In this Alice in Wonderland world, characterized by its vast post-crisis monetary policy experiment, we really have gone down the rabbit hole. You can say that again. Negative rates are supposed to stimulate the economy, incentivizing investment by making it less attractive to hold cash, and spurring demand by making credit cheaper. But evidence of the theory working in practice is far from conclusive. Certainly, Europe's bankers are squealing as they feel margins squeezed by low rates on lending and the reluctance to pass on negative rates to depositors. Yeah, you think, the zero low brown problem exactly. Who's going to lend people money when they'd make more by just holding on to the money and putting it under their mattress? Last week, famously blunt ING boss, Ralph Hammers, excelled himself all but calling the ECB idiotic for planning to shift the rates further downwards. Again, because of the zero low brown problem, I doubt this policy is going to be that effective. Quantitative easing, sure. Printing money, buying assets, yeah, okay, that might make a difference. But negative interest rates? Again, at that point, you just take the money out of a bank and put it under your mattress if you have any common sense. The negative rate environment is making consumers so uncertain about their financial environment that they're starting to save more rather than less, he said. I guess he's saying similar stuff. Mr. Hammers has a point. Rather than encouraging people to borrow and spend, the data suggests nervous Eurozone customers are hoarding. Eurostat reports the Eurozone household savings ratio is at a 5-year high of nearly 13%. Now, putting their money in a bank, or even better yet, an investment fund like an index fund, then that would be a really good thing. But if they're taking it completely out of the economy and financial system and just putting it under their mattress, then that's a really, really bad thing. A similar but more dramatic phenomena seems to be in evidence among the big wealth managers. One reason why UBS and CS are planning to pass on negative rates is that the wealthy client's obsession with cash has become such a large problem for them. UBS reckons that 26% of its clients' assets are held in cash. At CS, the proportion is 29%. This runs counter to the theory that investors right around the world are hungry for investment returns. Starved of decent yields on bonds, they have supposedly been drawn into riskier asset classes. There is clear evidence of this happening among institutional investors. The flow of pension fund money into any asset that promises to beat zero-rate bonds has been so dramatic that equities, junk bonds, property, private equity, and a host of other more abstruse areas of investment have spiraled in value. Yes, because if the safe bonds are yielding nothing, or even if the rates are just going down, then the lower returns are going to force wealth and funds into higher return areas which are higher risk. And so that's going to lead to more investment in more higher yield and less ultra safe investments. And to such an extent that they look highly vulnerable to any shocks. US recession, no-deal Brexit, more extreme US-China trade tensions, I think that's coming, and escalating standoff between Iran and the West. This indeed is one theory why the Swiss bank's wealth clients are being so cautious. Wealth advisors say clients have been missing out on returns for a decade, fearful that the 2008 crash will be replicated in the next recession. But at this point, they are probably being perfectly rational in showing reluctance to invest at the top of the market. There may also be a regional bias. Ultra-wealthy Swiss clients surrounded by anemic European economic performance are more cautious than bullish Americans. I guess that makes sense. Certainly some rival banks report very different risk appetites. Raymond James, a U.S. wealth manager, has seen clients push their cash holdings to record lows of about 6% in the US and below 5% in the UK as they desperately seek out returns. Who's to say which stance is right? The downturn will come, but it may be some time away, and the opportunity cost of staying in cash could be large. As long as the music is playing, you've got to get up and dance. So infamously said Chuck Prince, Citigroup's former boss, ultimately to the cost of his job and the viability of his bank. What then is the solution? Clients keen to maintain their cautious cash-based approach, but dodge negative interest rates, could bear that in mind. For 1,000 a year Swiss francs, your typical Swiss private bank will give you a cubic meter of vault storage for your valuables. Thanks to Switzerland's high-value 1,000 notes, that should be enough space to salt away close to $1 billion in hard cash. See exactly, putting the money under your mattress and in the vault. This fee is a slight cheaper than the $7.5 million charge that a 0.75% negative interest rate would imply. Hiding money in vaults is probably not the most productive dynamic that policymakers were hoping for, you think? But it's starting to make sense. Welcome to the rabbit hole. Yeah, see, they're saying exactly this. Negative interest rates do not make sense because of zero lower bound, and people will just hoard their money and put it in vaults under their mattress rather than keep it in the economy. While negative real rates, in which the headline interest rate is lower than inflation, could work because cash won't be doing any better because it'd be losing value through inflation, zero lower bounds and negative outright interest rates are just really something that should not work. And it's absolutely amazing that bond yields for assets like even ultra-safe German bonds, like not 1 years, but 10 years, are yielding so low. Who knows what's going to happen in the future? The inflation rate in Europe over the next 10 years is probably going to be around 2%. So you add up another outright negative 0.5% on top of that, and you're yielding negative 2.5% a year. You're losing 2.5% value a year. What sense does that make? And who knows, if on the off chance something bad happens in the euro, there'd probably be even higher inflation than that. Ugh. And why would investors settle for losing 2.5% when they could put their money elsewhere like a US 10-year, and get some sort of positive return, or at least a return that's not outright losing money. I mean, yeah, there's exchange rate risk, but it beats a sure loss of putting your money in a German bond at this point. Well, anyway, that's my rant about negative interest rates and what these fellows at Financial Times have to say about it. So please like this video and subscribe to my channel, hit the notification bell, and leave your thoughts in the comment section. Please do any one of these things. I'd really appreciate it.